Welcome to the Real News Network. I'm Paul Jay in Washington. Concentration of ownership leads to concentration of political power. It's rather obvious. It's practically a truism, but it's not something you will hear said very often on mainstream media. But it certainly goes to the core of what's happening in Europe, Greece, and in the United States and Canada, and most other countries, if not all. Now joining us to talk about the relationship of banks, big banks, financial power, and public policy is Michael Hudson. Michael was a former Wall Street financial analyst. He's now a distinguished research professor of economics at the University of Missouri, Kansas City, and you can find his work at michael-hudson.com. Thanks for joining us, Michael.
Very much, Paul.
You've written that all economies are planned to some extent. This idea that there's simply a free market without government planning is not very realistic. But you've raised the question, but who does the planning and for whom? Talk about this.
In the past, ever since the Neolithic, agriculture, wherever you have a division of labor and a time gap between production and a final payment, planting and harvesting, you need forward planning. The whole idea from the 18th and 19th and early 20th century is that the governments would make a forward plan. The French call this planification, or indicative planning. But if the governments don't plan to make subsidies and tariffs and taxes, then if you dismantle government planning, then by default, all of the planning passes into the hands of bankers. And the bankers end up allocating the nation's resources because it's the bankers who give the credit. And instead of the government deciding how to steer the economy forward by subsidizing education, by building private infrastructure, all of a sudden the infrastructure and the division of labor and the resources are passed on to the banks, and the banks are going to decide, okay, sell all the public domain, sell the roads and the railway systems and the power systems, and we will decide who gets the credit, and we'll do the planning. Well, the problem is that the financial time frame is very short term. It's hit and run. They're into making a bundle as quick as they can on one project and then go on to the next project. They leave an economy loaded down with debt, which is what you have from the corporate takeover movement, from the hedge funds, from the leveraged buyouts. The financial plan is to take all of the revenue of a corporation and see how much revenue can be pledged to pay debt service, and we're going to find a buyer who's going to buy this company and pledge all the cash flow to us and get the company. Well, this doesn't leave any money left for tangible capital investment in new plant and equipment. Just like in a building, if Donald Trump or a real estate investor is buying a property, the basic motto of a real estate investor is rent is for paying interest. An investor will calculate how much rent is there, and they'll bid for a big office building. The winner is the person who pledges the whole of the rental cash flow to the bank for interest, and they do this because they're not after the rent. They're after the capital gain as banks keep lending more and more money for the process to increase the whole price, and what you have is asset price inflation. Well, what's so unique about this is in Europe you have this whole implanted memory of the German hyperinflation in the 1920s, that the Germans and the Europeans say, well, wait a minute, we can't have a central bank lending to governments because that's inflationary. Whereas, in fact, we've just seen this huge inflation by the commercial banking system in the United States, England, and Europe, but what they've inflated isn't commodity prices or wages or consumer prices. They've inflated housing prices, stock prices, bond prices, the price of buying a retirement income. And so the commercial banks tend to inflate the prices of assets. And what that has done is increase the value of wealth and real estate and corporate ownership and finance relative to labor. So there's been an enormous concentration of wealth in the United States and polarization since interest rates began to come down in 1980 from 20% then to about 1% now.
Right.
So the financial plan is basically an asset grab. They want to load the whole economy down with debt. A consumer will come in and say, I'd like to take out a loan. They'll say, how much do you earn? Everything over subsistence they'll want is a loan. When I was at Chase Manhattan, for instance, I joined in 1994 and 1964. I'm sorry. My first job was to analyze Argentina, Brazil, and Chile, and my job was to see how much of a surplus in foreign exchange can these countries generate by exporting, by selling off their property, and once we have the surplus, if that's capitalized all into debt service, how much can they afford to borrow from us in order so that we can get paid their entire surplus for making loans for them? And then what's the proportion of Chase's loans to other New York banks and other American banks? And so we'll all have the whole economic surplus of entire countries being paid to the banks. Well, once the surplus is paid to the banks, there's nothing over for rising living standards. There's nothing over for new capital investment. There's nothing over for long-term research and development. When you have Harry Kravis or the other takeover artists take over a company, the first thing they do is cut back long-term projects. They cut back research and development. They slash projects that have a long maturation period.
Right, Michael.
And take it out.
You know, if you look at the sort of graph of the strength of the financial sector, size of the financial sector in relationship to the GDP, it gets very, very high around 1931, 1932. It sort of starts to go down, then it really dips in World War II. After World War II, it's like a steady climb. But it seems like in terms of planning and government planning, that you could say, 1980s, 70s, you had a little more mix, that you had government planning always, you could say, in the final analysis, in the interest of the elites and but more various sectors of the economy than just so much the financial sector. Where now it seems like by far the weight of public policy is on the side or being directed by the finance sector. If you agree with that as an idea, why?
Even let's take the case of the industrial corporations. Prior to 1980, well, in the 1930s, most industrial corporations, if you look at who was a CEO, they were lawyers, because the lawyers had to deal with debt and insolvency. During World War II, they tended to be military people, generals. They also were industrial technologists. They were inventors. They were people who came from the production end. Then, from about the 1960s and 70s, you had salesmen become the CEOs. They were people who focused on marketing, because that was how the industrial into production. But since 1980, you had a change. The business school focus was shifted, and Robert Locke recently wrote a book on business school education, pointing out that the whole focus of business school education now was to have industrial companies run by financial managers, not salesmen, not production end, not lawyers, but financial managers. And so you have a system where not only are the banks allocating credit in the economy, but the corporate sector itself, the industrial sector, is treating industrial companies, as if the purpose was to squeeze out a financial surplus to pay bondholders and stockholders. And of course, you also have the phenomenon since 1980 that you really didn't have before of stock options. If you pay the managers in stock options, the whole objective of running a company is to increase the value of the rewards that the managers get by exercising the stock options.
Now, so but is the strength of the financial sector and the fact that, as you're describing in terms of corporate leadership, so much is about finance, is the underlying issue there is that there's more money to be made through finance and speculation and such, and less through what was considered more normal productive activity?
It's certainly easier money. It's easier to, if you're a corporation and you have, say, $1 million cash flow, and you have a choice. Am I going to invest this in trying to develop a new product that's very risky and then how to market it, or am I going to use it to buy my own stock? If you just use this money on a stock buyback to buy their stock, they're going to raise the price of the stock. This increases the value of the stock option that the managers give themselves, and all of a sudden they make money that way. They don't have to worry about developing a new product, of getting approval, of finding markets for it, of advertising.
So whether it's financial speculation or these kinds of buybacks, parasitical activity winds up being more profitable than productive activity.
It's quicker and it's easier to make a Ponzi scheme than to create an actual industrial advance. That's why all the financial managers would love to do what Bernie Madoff did and do a Ponzi scheme, because it's really easier to do that than to actually make money by being productive.
All right, thanks for joining us, Michael.
Thank you very much.
Thanks for joining us on the Real News Network.